If you're planning the big move to the UK, then it's time to talk tax before it talks to you. This one's a bit of a long ride, but bear with us. There are a lot of ins and outs when it comes to moving to the UK in 2026, especially if you're hopping over from New Zealand or Australia. We're talking new rules, gone assumptions, and tax twists that love to hide in the fine print. But don't worry, we're not here to scare you, just to make sure you don't get blindsided later. So, let's break it down. The old non-dom safety net? Gone. For years, Kiwis and Aussies relied on the UK's non-domiciled status like a tax invisibility cloak. From April 2025, that cloak disappeared for good. Enter the FIG regime, foreign income and gains. A 4-year honeymoon where some foreign income stays out of the UK tax net. Sounds dreamy. Until you realise claiming FIG means giving up your UK personal allowance, a bit over £12,500 of tax-free income. So, if you're earning mainly in the UK, that honeymoon could cost you more than it saves. First rule of UK Tax Club, you're probably a tax resident. UK tax residency isn't based on the day you land, it's based on days spent, work, accommodation, and sometimes UK ties. You might feel like a visitor, but HMRC might disagree. And that back home income, HMRC sees it. Your New Zealand savings account, Aussie rental, or old dividends. If you're a UK tax resident, worldwide income is on the table. And since April 2025, the handy £2,000 foreign income exemption, gone. Now even small overseas earnings can mean UK tax returns. The tax owed may be low, but the admin, definitely not. And if you're thinking, but I already paid tax on that overseas, HMRC still wants you to report it. Double tax agreements stop double taxation, not double paperwork. Even if the final bill is £0, you'll still need to crunch the numbers. And what about selling assets? Watch the timing. If you sell your New Zealand home or Aussie shares after becoming UK resident, even if your home country doesn't tax it, the UK might. And the UK doesn't reset asset values when you arrive. They tax the gain from what you originally paid. And Australians, be aware, the UK may ignore your exit tax reset, meaning the same gain gets taxed twice. Thinking of contracting in the UK? The structure you choose matters. Back home, being a sole trader might have been the norm, but in the UK, a limited company is usually more tax efficient and gives you more credibility with recruiters and clients. But if you're not quite ready to jump into that, umbrella companies are a great low-fuss option to get started. They handle the admin, you just get paid. Simple. But there's a curveball called IR35, the UK's way of checking whether you're really self-employed or just working like a regular employee through a company. It doesn't stop you setting up a company, but it can change how you're taxed. Now, what if you're keeping your job with a Kiwi or Aussie employer and just working remotely from the UK? Sounds easy, but once you're UK tax resident, that income becomes taxable in the UK, even if your employer's got zero presence here. If they won't set up a UK payroll, there's a workaround, DPNI. That's where you pay your income tax and national insurance directly to HMRC. Clean, compliant, and no awkward calls from the tax office. Almost done, but there are a couple more traps worth flagging. Let's talk about retirement savings before they sneak up on you. Kiwis over in Aussie Super work great. Until they don't. Withdrawals while a UK tax resident can be treated as taxable income. Meanwhile, UK ISAs are a tax-free dream. Save or invest up to £20,000 per year. No income tax, no capital gains, no reporting. Start using them early. Your future self will thank you. And lastly, inheritance tax and the 10-year shadow. You might think you're off the UK tax radar the moment you leave. Not quite. If you've been UK tax resident for 10 out of the last 20 years, your worldwide assets can still be caught in the inheritance tax net for up to 10 years after you leave. Not a reason to panic, but definitely one to plan for. 3 countries, 3 tax years and 1 administrative headache. The UK tax year runs from 6th of April to 5th of April. New Zealand goes 1st of April to 31st of March, and Australia, 1 July to 30th of June. None of them line up. So if you've got income in more than one place, expect mismatched reporting periods and a bit of extra admin. Not a tax disaster, but definitely something to be across from day one. And that's it. We are done. Moving to the UK can open amazing doors, but it's not as simple as change country and carry on. The tax system here has rules and wrinkles that can trip you up if you're not ready. Get informed, plan ahead, and avoid, I owe what? Because no worries shouldn't just be a phrase, it should be your tax situation too.